Hello, everyone, and welcome back to Gold Off the Charts. In a financial market defined by volatility, power plays, and uncertainty, we look past the surface noise to uncover what's really happening behind the scenes. A daily dose of deep financial insight will help you see further, trade smarter, and outlast the competition on your journey to building wealth. We're filming today's video because we are truly witnessing a miracle. Why? Because in the last 24 hours, the gold market has seen an unprecedented explosion in volatility. On Friday, January 23rd, spot gold prices skyrocketed, blowing past every resistance level and overbought signal to hit a massive record high of $4,967 per ounce. Think about that for a second. We are just a stone's throw away from $5,000, a price target that was once dismissed as total fantasy. This isn't just a solo run for gold, it sparked a massive rally across the entire precious metals sector. Spot silver jumped 2.6%, closing in on the $100 mark. Spot platinum surged over 6.3%, with both hitting all-time highs. This everything rally in metals is a direct reflection of the extreme anxiety gripping the market right now. Geopolitical uncertainty, a weakening US dollar, and expectations of Fed rate cuts all hit a breaking point at the exact same time. I know many of you watching are feeling a mix of excitement and nerves. You're excited because if you're already holding gold, your portfolio is basically seeing money fall from the sky. But you're also nervous because when prices move this fast, you have to wonder, is something huge about to happen? Is a major war coming, or is the dollar system actually collapsing? However, with gold staring down $5,000, we need to stay level-headed and ask the most important question. What is the real force driving gold to these heights? Listen closely. If you think gold is hitting 5,000 just because of a headline about Trump and Iceland, or a minor dip in the dollar index, you're being a bit naive. If that's your view, you're missing the most critical and, honestly, the most shocking truth behind this rally. I'm about to give you a perspective that might change how you see the markets. Behind the headlines, a silent financial coup is taking place. The real engine behind this gold surge isn't the politicians you see on the news. It's the deep-sea whales, the world's biggest institutional funds, who are now scrambling to enter the market at any cost, regardless of the price. The rules of the gold market have been completely rewritten. It's no longer just a numbers game for central banks managing their reserves. It has turned into a survival mission for global private capital looking for a lifeboat in a stormy world. We'll also dive into today's massive decision by the Bank of Japan. We'll look at a warning sign in the Japanese bond market that most people missed, but has analysts terrified it could be the next black swan to hit the global economy. Watching the charts is one thing, but making money is what matters. In this once-in-a-generation market, how should an everyday investor actually trade? Should you jump into the bubble, or take your profits and run? Are you ready? Let's dive into today's analysis. First, let's look at the spark that lit this fuse: Greenland. It sounds like a meme, but the logic behind it is very serious. Geopolitical tension is always a gasoline for gold prices, and the recent dispute over Greenland has brought these tensions to a boiling point. As you know, just 2 days ago, Trump was threatening tariffs on Europe and talking about buying Greenland. Then, yesterday, he suddenly announced a deal with NATO. The deal is fascinating. It grants the U.S. full and permanent access to Greenland. While this calmed the immediate drama with Europe, the underlying issues are deep. European allies are breathing a sigh of relief for now, glad they dodged a trade war, but the trust is clearly broken. Trump's flip-flopping from threatening military action to suddenly playing nice felt like a chaotic reality show, and it sent shockwaves through the global markets. On the surface, European leaders are saying the problem is solved. But behind closed doors at the EU summit in Brussels, everyone is asking the same thing. How reliable is the US as a partner? They're thinking, if they can threaten us over Greenland today, what's next? Can we still trust our big brother? This uncertainty is a massive buy signal for safe haven assets. With leaders in Greenland and Denmark stressing that sovereignty is a red line, investors are becoming increasingly worried about global stability. This is driving a stampede of capital into gold. Between geopolitics, a weak dollar, and Fed cuts, the de-dollarization trend is hitting full speed. Gold isn't just a commodity anymore. It's the ultimate hedge against international conflict. I want to stress that the entire logic of the gold market has flipped. Look at yesterday's data. US GDP growth for Q3 was revised up to 4.4%. A few years ago, this would have sent the dollar soaring and gold crashing. A strong economy usually means higher rates and a stronger currency. But what happened yesterday? The dollar couldn't be saved. The dollar index dropped 0.5%, sliding toward the 98 level. What does that tell us? It means we are in a win-win scenario for gold. Bad data is good for gold, and good data isn't even bad for it anymore. Gold has broken free from traditional economic correlations. It has moved to a higher strategic level. It's no longer just a shadow of the dollar, it's the dollar's gravedigger. Now, let's get to the heart of the matter. This is the part I really want to share. The game has changed. For 2 years, we said central banks were the ones buying gold. We focused on China and Russia stacking gold. But now, it's different. It's not just the governments anymore. The private whales have arrived. I'm talking about family offices and hedge funds that manage trillions of dollars. They are rushing in. Why? Because they are scared. They are hedging against global policy risk. Analysts at Goldman Sachs recently released a report on January 21st that changed everything. Don Striven and Lena Thomas made a bold move in their latest update. They hiked their December 2026 gold price target to $5,400 per ounce, up from $4,900. Remember, Goldman is the gold standard of Wall Street banks. They have the best data and the most advanced models. Their reasons aren't just the usual suspects like central bank buying or Fed cuts. While safe haven demand is high, the real game changer is an upside risk they've warned about that is finally coming true. Private sector demand for gold has become sticky. What does sticky mean in trading? It means these funds aren't just renting gold for a quick trade, they are marrying it. They aren't planning to sell anytime soon. This creates a permanent floor for the price. Goldman breaks the last 3 years into 2 distinct phases, and this is brilliant. Let's look at it. Phase 1, 2023 to 2024, this was a steady climb driven by central banks. The turning point was when Russian reserves were frozen. That sent a shockwave through every emerging market central bank. They realized their US dollars and treasury bonds could be seized at any moment. So, they started panic buying gold. It was a strategic shift by governments. That was the first leg up. Phase 2 starting in 2025, this is where we are now, the scramble for physical bars. Goldman believes the 2025 rally is accelerating because while central banks are still buying a pack of wolves, private investors has joined the hunt. They are now competing with governments for a limited supply of physical gold. This creates a double whammy effect on demand. On one hand, traditional Western ETFs like GLD are seeing massive inflows again as the Fed cuts rates. Low rates make gold much more attractive to hold. On the other hand, a brand new demand channel has opened up, high net worth families buying physical bars. The ultra wealthy are looking at the chaos and deciding their stocks and bonds aren't enough. They want real gold bars in their private vaults. At the same time, traders are piling into hidden hedging tools like call options. This shows that the current buying is long-term insurance, not just a short-term gamble. Goldman's biggest assumption for their $5,400 target is this: private investors hedging against global macro tail risks aren't going to sell in 2026. They call this sticky hedging. This is a vital concept. If this were event-based hedging, like betting on a specific tariff, the money would leave as soon as the news broke. If the threat went away, the price would crash. But macro policy hedging is different. These people are worried about unsustainable U.S. debt, long-term inflation, and global instability. Can these be fixed overnight? No. Can the U.S. magically pay off its debt? No. Can inflation just vanish? Not likely. Therefore, these positions are staying in the market. In fact, they are likely to grow. This raises the entire baseline for the price. Goldman isn't just saying 2026 demand will be higher. They're saying this high price is the new normal and is fundamentally supported. They expect gold to rise another 17% by the end of 2026. Breaking that down, central bank buying adds about 14%, buying 60 tons a month is massive. The return to Western ETFs adds another 3%. Sticky hedging ensures that the current high price isn't a bubble, but a new floor. The report also mentions a technical factor called gamma hedging, which I'll simplify for you. When investors buy tons of call options, the market makers who sell them have to buy physical gold or futures to cover their own risk. This creates a virtuous cycle. More people buy options, so market makers buy more gold, which drives the price up. As the price goes up, more people want options. This leads to a short squeeze that supercharges the rally. Goldman did mention 3 things that could end the party. First watch. If central bank buying drops back to pre-2022 levels, around 17 tons a month. Second, watch the Fed. If they suddenly start hiking rates again, that would hurt gold. But that's not on the horizon. Third, if macro uncertainty is solved, if world peace suddenly breaks out and US debt disappears, gold will fall. The odds of that? Very low. So, unless those three things flip, the gold bull market is just getting started. It's shifting into second gear and ready to accelerate. Now that we've covered the financial side of gold, let's look east to the other powder keg that could blow up the markets, Japan. You might think Japan doesn't matter for gold. You'd be wrong. Japan is the world's largest creditor, and the yen is the engine for global carry trades. If Japan shakes, the whole world feels the earthquake. Today, the Bank of Japan held its rate meeting. The results looked standard. Rates stayed the same. But under the surface, the yen and Japanese bonds are facing massive volatility. The BOJ voted 8-1 to keep rates at 0.75%. That's the highest since 1995. The lone no vote wanted an immediate hike to 1%, showing that even the central bank is becoming divided and hawkish. The hawks are gaining ground, but the real red flag is the Japanese government bond JGB market. Get this. On Tuesday, long-term Japanese bond prices crashed, and yields, interest rates, spiked. But the scariest part was how little trading it took to cause that crash. Turnover for the 30-year bond was only $1.7 billion. For a 40-year bond, it was $1.1 billion. That's almost nothing. We are talking about a $7.2 trillion market. It only took $2.8 billion in selling to bring the whole thing to the edge of a cliff. It caused yields to skyrocket by 25 basis points. This means the Japanese bond market is becoming a liquidity desert, a ghost town. When everything is fine, it looks normal. But the moment someone tries to sell and run for the exit, they realize the door is the size of a needle. Analysts are calling this Japan's Liz Truss moment. Remember when the UK bond market almost collapsed under Truss? Pensions were nearly wiped out. Japan is now facing that exact same risk. For years, the BOJ's massive stimulus kept the market artificially frozen and calm. But now that the BOJ is stepping back and stopped buying everything, the market has become incredibly fragile. The reasons are clear. Japan is finally dealing with inflation, and rising rates are shattering years of artificial calm. Meanwhile, Prime Minister Sanae Takaichi is proposing tax cuts on food. This is clearly a move to win votes for the upcoming election, but it has the market terrified that Japan's spending is out of control. Japan is stuck between a rock and a hard place. They need to raise rates to fight inflation, but if they do, bond prices crash and Japanese banks are loaded with those bonds. Their balance sheets could be destroyed instantly. Prime Minister Takaichi's plan to throw money at voters is the final straw. This is exactly what Liz Truss did. When inflation is high, the market hates fiscal stimulus. Investors will dump your bonds in a heartbeat. You're probably wondering, what does this have to do with my gold trade? Everything! Japan is a global money reservoir. If the Japanese bond market collapses or the yen goes haywire, global capital will act like a flock of scared birds looking for a place to hide. Where do they go? U.S. treasuries? The U.S. is drowning in debt? The euro? Europe is a mess? That leaves only gold. So the chaos in Japan is just more fuel for the gold bull market. Many of you are asking, should I buy now or wait for a dip? My advice, if you're a long-term investor, don't sweat a $100 or $200 price swing. Below $5,000, any pullback. Well, it's a gift and a chance to get on the bus. The big picture trend is up. If you're a short-term trader, be careful. 5,000 is a massive psychological level. Expect a lot of chop and volatility here as the market decides its next move. Don't over-leverage. Survival is the goal. In a historic market like this, the worst feeling isn't being stuck in a trade, it's being left behind on the sidelines. You might be right about the direction, but if you wait for a perfect pullback that never comes, you'll watch the train leave the station without you. Let's wrap up. We are at a once-in-a-century turning point. Geopolitical tension is permanent. The Greenland deal is just the start of the great game for the Arctic. Europe no longer trusts the U.S. The de-dollarization is structural. Even with good U.S. data, the dollar is falling. That's the market, voting with its feet. Institutional whales are all in. Goldman's report proves that it's not just central banks anymore. Private money is moving in for the long haul, creating a much higher floor for prices. And watch Japan. Their liquidity black hole could swallow global financial stability at any time, forcing everyone into the ultimate safe haven. Even though gold is at all-time highs and approaching $5,000, given the state of the world, I believe gold is still reasonably priced. You could even argue it's cheap compared to the risks we face. We are watching the global monetary order being rebuilt. Gold isn't just a metal anymore. It's an anchor of trust. I wouldn't be shocked to see $6,000 gold this year. It's not crazy, it's a trend. It's the market repricing a collapsing old order. Finally, a quick reminder. These are my personal observations based on deep dives into market data and logic. My goal is to help you cut through the noise of the markets. This is not financial advice. Trading involves risk, so please be careful. Every trader's situation is different, so make sure you make your own decisions based on your own risk tolerance. Thanks for watching. If this helped you make sense of the market, please leave a comment and share your thoughts. Don't forget to like, subscribe to Gold Off the Charts, and share this with your fellow traders. See you in the next one.